I'll introduce you then.
Fantastic.
So today we're very lucky to have David Gerard. He is a crypto journalist. He's been covering the space since 2011, over a decade, from the very early days. Typically from a very skeptical perspective. If you're a huge fan of crypto, I'm sure you'll have lots of questions, which is encouraged. He's written 2 books. They're both very, very good. There's a very dry sense of humor, but don't let it distract you from the fact that they're extremely well-researched books that make a very strong argument. His first book is about Bitcoin, essentially, written in 2017, just as the first major crypto bubble was kicking off. That's a really dissection of the whole Bitcoin phenomenon as it stood in 2017. It's excellent. His second book is on Libra, or DM, the Facebook currency. I don't think anyone will really have a problem with that book because nobody likes Facebook. So yeah, everyone will be able to enjoy that without feeling offended. Again, it's very good, very dry sense of humor, very readable. I'd highly recommend them both. So I will pass you over to David now, and he's going to talk about blockchain and the crypto world generally. So whenever you're ready, David.
Okay, so this is today's talk. Basically, it's every time I do a talk, some people mostly don't know what a blockchain is. They will, some of them will, but a lot of people, we're talking about this thing at length, and then someone will come afterward and say, what actually is a blockchain? And then they're all confused. So one thing I'm going to do is take you through exactly what it is. This is with particular view to finance and markets. So basically, it sounds like magical internet money, but you can make money from it. On the other hand, you're much more likely to lose your shirt. But let's go through it. This is my first book, Attack of the 50-Foot Blockchain. This is my second one, Libra Shrugged. This is me. I was originally a music journalist. I moved into IT. I started following Bitcoin in 2011. I really started paying a lot of attention around 2014, 2015, and wrote Attack of the 50-Foot Blockchain. That came out July 2017, just in time for the 2017 crypto bubble, and it took off. The Libra Shrugged, the book about Facebook's bad cryptocurrency, came out late 2020. I also have a news site. We'll have the PDF of these slides for you afterwards, and that's a clickable link. So if you're taking notes, don't feel you have to scribble down everything unless that helps you remember stuff. But yeah, this talk will be aiming for 45 minutes to an hour, and then we'll have a question period as long as you need afterwards, basically. So if you have lots and lots of questions, save them for the end, and we'll have an excellent question session, I'm sure, because the questions are always the really good bit. Now then, today's talk. Got 5 things. The first is the fabulous promises. You've heard amazing things about what crypto can do for the world, how the blockchain will turn the world upside down. And you might think they're a bit outlandish, but we'll go through them. Secondly, what a blockchain actually is. It is so simple that I explain it to non-technical people all the time. Third, Bitcoin, where it all started, the whole cryptocurrency thing. Fourth, cryptocurrency and finance, particularly opposite to this course. There are people who make a bundle of money out of this, and they make money out of the people who don't make money out of it. And fifth, we'll have a few words on blockchain in the enterprise. We have IBM and so forth promoting something called blockchain to companies that it'll fix all their bureaucratic problems. and this may not turn out to be the case. So let's get into it. The fabulous promises. These are great promises. So what can crypto do for you? It's trustless. You don't trust anyone about the state of the system. It's decentralized, no central controller. It's fast and it's free. Fantastic stuff. It is uncensorable and irreversible. It's immune to bad actors. It just shakes them out. And is secured by mathematics itself. Let's see how these work out. So cryptographers really hate the term crypto for cryptocurrency. Unfortunately, it's common finance jargon now, so it's a bit late. Trustless. You have to ask the question who you're not trusting. Do you have a security threat model? Who is it you don't trust? Why don't you trust them? Why can't you trust someone? Because it turns out that just having someone you can trust as an authority is hugely more efficient. It's actually a bit weird not to want that in a system. You have to have someone who's a final person responsible, usually. So it's also a thing where they take a word that has a specific mathematical jargon meaning and they try to use it as a general English word. This is a form of marketing nonsense. It literally means a computer that doesn't have to trust another computer in particular circumstances. And this is all like detailed mathematical computer science stuff. It's not the general sense of the word trusting people. Decentralized, like what is your threat model? What are you being decentralized against? The actual answer is governments of any sort, but we'll get to that. Fast and free. Well, except that that hasn't been true since about 2015, 2016, and Bitcoin and Ethereum transactions are notably expensive. Like you may have heard about people having to spend $100 making their monkey picture NFT. Uncensorable and irreversible. So that bit's actually true. Blockchain systems are designed so you can't reverse transactions. So the next question is whether that's actually a good idea. It turns out not to be in a lot of cases. And secured by math. So you'll hear about cryptocurrency hacks all the time. They happen daily. But crypto people still go on about how secure the blockchain is. That's because they talk about the cryptographic construct itself and pretend the whole rest of the system with the humans in it doesn't exist. Everything that goes wrong except the cryptography itself is redefined as user error. You shouldn't have done that. Oh, you were holding it wrong. That sort of thing. So yeah. Now, obviously, for these promises to be made at all, we need some pretty magical software. So let's look at the magic bit. What on earth is a blockchain? This is quite a simple construct. I'll take you through it very slowly. So this is the first question everyone asks. So it's an old data structure. You don't have to know computer science for this. If you do, look up Merkle tree in Wikipedia. You'll see how this works. It's an old data structure. It was adopted by Bitcoin. There's about 30 years of stuff before Bitcoin itself came out in 2009 that it built upon. The guy who created Bitcoin acknowledged all this. But a lot of Bitcoin advocates talk like he invented it all out of his own head. He didn't. So there's a lot of previous work. So the good part is simple and the bad part is silly. We'll get to this. Now, let's start with a simple accounting ledger. So you can see what this is. It's just like from some guy to some other guy, we have a date, we have an amount. We have just this list. That's all it is. So what do we do with this ledger? How do we know it's actually correct and hasn't been tampered with? What do we do to protect against errors in any data? So there are other fields where this is important, such as credit cards. If you put a credit card number in, you really want to know it's correct. Now, the way it works is this is a Visa test number. It's a standard test number that Visa say, here, use this number to test your software. that 1 at the end is not actually part of the credit card number. It's a check digit. It's calculated from the other digits. It's a checksum. This is common in computing. You do a checksum at the end just to check that numbers are correct. Another example is the ISBN, the number on the back of books. The last digit, that's a check digit. If that number is wrong, then the software will immediately check that this is a valid number and see the check digits are wrong and someone must have transposed digits or something. It'll ask you again for a number. This works really well. Now, in computing, we have hashes. So a hash is a much longer checksum. You can feed any data into a hash function. It'll come up with a number. So that string of letters and numbers, you'll have seen strings like this on the internet lots and lots. That usually means it's a hash of something. If there's a bunch of gibberish with AB8743, blah, blah, that sort of thing, it's probably the hash of something. That's actually a number because that's hexadecimal digits. So the letters are actually numbers as well. It's just a number. Now, the great thing about hashes is if the hash is the same, then the data that went in is almost certainly the same. Like you can have hash collisions, but a good hash will almost never have them. So we use this in computing a lot to say that if two things hash the same, they must be the same thing. It's very common. And a hash is really fast to calculate. That's a key point. It's very fast to do hashes. But the good part is you can't reverse them. If I have that hash there, I can't tell you what data generated that hash. It's almost impossible to turn it backwards. So it's basically a one-way function. It's really good. That means it's very hard to do forgeries. You cannot come up with a hash and then forge a piece of data to match it. So that's really nice. Now we'll use this in our ledger. So what we do is each line of it, we've got a hash at the end. I just made these up, but that's an illustration of how it works. So you have the data and you have the hash at the end. If you ever need to check that this hasn't been corrupted, you can calculate that hash yourself to check that the ledger is correct and hasn't been tampered with. So what if we want to know the whole thing is correct? How do we want to know that someone has not added lines or removed lines? So what we do is we take the hash of the hashes. So for those of you who know your computer science, this is a very nice little thing that the hash of a hash has the same cryptographic guarantees as just the hash itself. That's the key insight behind the Merkle tree. Those of you who don't know computer science don't need to know this. You just need to know the hash of hashes also tells you whether any of this has been tampered with. So if we have like 1,000 lines, not just 5, that means if we add a new line, we don't have to recalculate all the data's hash. All we need to do is recalculate that new line, then recalculate the hash of the hashes, and we're right. You can speed this up by taking hashes of hashes of hashes. That can be more efficient, and most real-life Merkle trees do that. Anyway, the point is, if we take hashes of hashes, then we know that the whole block has to come to that hash. Then we can make a chain of the blocks. So we've got these transactions at the top. We've got a hash of that. We put that hash as an input to the other hashes here, get that hash. Put that hash as an input to those hashes, we get that hash. It's really good. So basically we end up with this sort of single hash that verifies the whole chain of transactions. Sorry, I'm getting a feedback here. We have a problem. My audio is feeding back. Is someone got a microphone on?
I will check.
1, 2. Okay, that's better.
Okay.
Anyway, yeah. So what this gives us, this hash of hashes construct, is a tamper-evident ledger that we can only add new things to. You can't change old entries. You can only add new entries. If you want to reverse a transaction, you have to add a new transaction that reverses the previous bad transaction. Like, that's just how accounting ledgers are supposed to work. So this is a really useful thing. It's a tamper-evident, append-only ledger. So you can distribute copies of the whole ledger. People can look at it and go, wow, that's correct, and I can verify it's correct. We use this a lot in computing. It's impossibly slow to fake, so you basically can't fake it. You can't correct it if it has been tampered with, but you'll know it's been fiddled with. So this is obviously useful for a lot of things. And this is a Merkle tree, and it was used in Bitcoin. That picture is the picture from the Wikipedia page on Merkle trees. You'll see they usually do it by taking hashes, hashes of hashes, then hashes of hashes of hashes, because it's faster to compute. But it's the same principle. A hash of hashes gives you the same guarantee as just the hash. That saves a lot of recomputation. So yeah, and therefore you have this chain of blocks, the blockchain. That's what it is. Now, that's a very cool thing in its way, but you'll notice it's not very magical. You have all these amazing promises for crypto. Where do they all come from? Who thought that this would somehow be a magical thing and say, oh, you just don't understand technology? Well, now you do understand the important part of the technology. Where's the magic? The promises came from Bitcoin. Now, Bitcoin sounds like an answer to digital cash, right? Digital cash would be a useful thing to have. You know, we have money. I can hand you £5 and you've got the £5. It's just from me to you, £5 note. We have the internet now. It would be really useful to do that on computers. So we could use this ledger. I mean, the way we do digital cash now is we have banks. The bank is the central authority. I go to the supermarket, I use my card, £5 goes from my account to the supermarket's account, I've bought my stuff. Handing you £5 is a little bit harder. I have to know your bank account number or whatever. Then I can send it in seconds, but it's very fiddly. It's not the same as handing you a £5 note. So digital cash is not an unreasonable thing to want. Perhaps we can do it with Bitcoin. And I thought perhaps we could use this hard to fake ledger for our new digital cash. Who gets to add new entries? This is the big question. Usually we do it with the central authority, a bank. They've got all the money, they store it away. They are regulated under a lot of laws and rules. There's bank guarantees, insurance, if the bank goes bankrupt. When Northern Rock collapsed in the 2008 financial crisis, everyone got their money back. The government guarantees held. It gives you confidence in the system that way. So the obvious answer is a central authority, a bank. But it turns out the Bitcoin people, that wasn't good enough for them. Because Bitcoin's founders were very strange people. Bitcoin was never meant to be a new payment system because we had lots of payment systems already by then. People have been trying electronic payment systems through the 90s and the 2000s. Bitcoin was invented as a political project. They were very sincere, extreme libertarians, like not just people who wanted a bit less government regulation, because regulations are annoying. I mean, no one likes to be told, but people who wanted no regulation whatsoever. Think of everything that you pay a government to do with your taxes, and no one's doing that. It's all business now. There's no central authority. They wanted no central authority in Bitcoin. They wanted no possible control. The actual threat model was they were worried governments would tax them. So that's why the irreversibility. You cannot reverse transactions in Bitcoin. You have to have a new transaction. That's so that governments couldn't take their back taxes out of their bank accounts. They also were very fond of the gold standard, what's called gold bugs colloquially. There aren't a lot of real gold bugs out in the world who think that money would be all better if it was gold. You'll meet a surprising number in finance. And everyone thinks they're a bit weird, but if they're good at their jobs, well, no one minds too much. But we went off the gold standard because it didn't work. There was too much economic activity for the gold in circulation. So it turned out that we actually needed monetary policy, fiat currency, central banks with guarantees, that sort of thing. This turned out to make a much more stable system that held it together a lot better. There's a lot wrong with our present system, a lot to complain about, but it's better than what happened before. So Bitcoin wanted a gold standard using technology to make a sort of digital gold. That's when the digital gold narrative for Bitcoin started. Nobody takes this seriously except Bitcoiners, but they think it's definitely digital gold. Also, credit is bad. You have to use the actual gold as money. The book to read on this is The Politics of Bitcoin by David Columbia. For my book, Attack of the 50-Foot Blockchain, I basically cribbed from his book for chapter 2. So I tell people to get this book every time I mention the subject, because it is the book on the subject. So yeah, they are very weird people. They're very sincere, but they were also very weird. So here are the fabulous promises of Bitcoin. This will look like the list that we saw at the beginning. It's decentralized, no central controller. That's very important. It's trustless. You don't have to trust anyone about the state of the system. You can see for yourself. It's fast and it's free. They've stopped saying that one since about 2017. Uncensorable and irreversible. It is true that it's irreversible. It is true that no one can stop you from making a transaction before the fact. And that's very important. They can trace you after the fact because you've got a complete ledger of all transactions back to 2009, and a lot of crooks get caught this way. Because crooks aren't very bright, they keep using it. But yeah. Bitcoin cannot have quantitative easing. No, just printing money. No, no, no. You have all the money you'll ever have. It's right there. Quantitative easing is not technically printing money. It's technically when you let the commercial banks make much more loans, which generates more money in the economy, but it has the same effect as just printing money. So we just call QE just printing money. But anyway, also Bitcoin will destroy banks and governments. They literally claimed this. Some of them still claim it. It's quite amazing. So I should have a word about the actual pitch for cryptocurrency. The original Bitcoin was not put forward as a scam. They were sincere people, but it attracted scammers like nothing on earth, because the other word for money that governments can't control, playground for crooks. If you listen to crypto people, you will understand what they're saying much more if you remember that the actual pitch is always, you can get rich for free. The obvious problem there is there's no such thing as a get rich quick scheme. There isn't. You work for your money, or you change politics so that you get more money and better resources, or you steal it, or something like that. There is no such thing as a get rich quick scheme that works. Now, getting rich for free, though, it's a very popular product. If you offer getting rich for free, people will flock to you offering you money. They will tell their friends to flock to you, offering you money for your get rich quick scheme. You don't even have to deliver, is the good bit. You know, you can say, well, for very complicated technical reasons, I'll go read the white paper. It'll explain it all. Oh, you don't understand it? You better just give me your money. And then, oh, I'm sorry, we got hacked. All the money is gone. Yes, yours in particular. All of the technology, all of the talk about tech, all of the, oh, it's very complicated. This is all hand waving to obscure the fundamental pitch, which is you can get rich for free. If you remember that there is no such thing as a get rich quick scheme, you will have the correct attitude, which is to look at it and go, okay, what's wrong with this? With a bit of practice, you get quite good at it. Thou wizard bloke, the picture there, that is an actual picture that was used by the Bitcoin subreddit on reddit.com to get people to come to the Bitcoin forum. You can see a number of issues immediately. So where do Bitcoins come from? And how do we do this decentralization trick and trustlessness and censorship proof and so forth? So a new bunch of Bitcoins comes out every 10 minutes or so, on average. It's actually an average of a certain number of times, a few thousand times every 2 weeks. So how do we do this with no central authority? The answer is we make it a lottery. Like Bitcoin mining, that's the process. Analogous with gold mining, they called it mining. It's actually running a huge lottery. So you get a block of transactions like the one we got at the beginning. Like they process one block of transactions at a time. You guess a random number. This is called the cryptographic nonce, which is a number used once. Whoever invented this wasn't aware of the unfortunate slang term. So, and we add that number to the end. Then we take the hash. So basically you guess a number, add it to your block, take the hash, and that's your lottery ticket. You'll see that's a very small number. It came out to just a tiny little number. If the resulting hash is a small enough number, you win the Bitcoins. Well done. And if you don't, guess another number. So you have a whole bunch of computers calculating hashes, guessing numbers over and over and over. You'll see in the press, they talk about this as Bitcoin computers run complicated calculations. They're not complicated, they're just hashes. Simple ones run very fast. 1.2 times 10 to the 23rd guesses at the moment every 10 minutes with just one winner. So the trouble with this is that it's literally anti-efficient. Like in actual finance, banks and so on, they use a lot of power. Data centers are very expensive, but all their incentives are to use less power. All their incentives are to save money on this because it's a cost. They don't want to use all that power. Also, they're about a million times more efficient than Bitcoin. Visa is 1 million times more efficient than Bitcoin, for example. So the way it works is, what happens if we get lots of people putting computers on to win the Bitcoins? It takes less than 10 minutes to win then. So what do we do about that? Well, we make it harder. So as more computers are added, it gets harder and harder. So it's a big competition seeing who can add the most computers. It ends up in what is called the Red Queen's race, where you're adding more power to stay in the same place. So at the moment, there's no upper limit on this. So at the moment, Bitcoin is using as much power as the whole country of Thailand. Like 134 terawatts total in 2021 was just sent up in smoke by Bitcoin. Now that's actually 0.5% of the whole world's electricity is just sent up as Bitcoin. That's quite a lot. So legally, it's their money. They can spend it on power if they want. But you are allowed to point at it and go, that's disastrous. Wasting a whole country's power and generating a country's carbon dioxide is probably a bit of an externality. And that's everyone's business. A lot of people get really angry about this. Like they think of Bitcoin as weird internet nerd money. Then they hear about proof of work mining and a country's worth of CO2 and they get angry. So I've cited my sources there, and those are actually links as well if you want to look them up. Also, this is predominantly fossil fuels. It's actually less than the typical average of sustainable versus fossil fuels. Bitcoiners know that this is their worst possible thing. And they say, oh, Bitcoin incentivizes the use of renewable power. Incentivizes is a word that means doesn't, because in practice, Bitcoin miners cause old fossil fuel plants to be reopened and started up again, burning coal or gas or something. Incentivizes is a word you say when you can't say actually does. And for all that, it does about 7 transactions a second. That's the same amount it did on two guys' PCs in 2009. All the rest of the power is just wasted guessing numbers. And it averages 3,200 kilowatt hours of power gone. And that generates about 1,000 kilograms of CO2 per transaction. I mean, that's averaged over the whole blockchain, you know. But that's the actual load per transaction. So what do we get out of this? Not a lot. We waste all of this power to get a completely decentralized system. Bitcoin advocates will tell you this is completely worth it. Absolutely. Now, you may wonder if that's worth 0.5% of the world's entire power consumption. So what does Bitcoin give us for this? So Bitcoin mining has economies of scale. That means it re-centralizes. Like it naturally, the bigger you are, the more efficient you are in terms of hashes you can generate per kilowatt hour. So Bitcoin had re-centralized by about early 2014. One mining pool could have taken over Bitcoin by about July. They broke up into multiple smaller pools. There are basically 3 or 4 mining pools issue most of the Bitcoins. And we have no idea if they're owned by different people. And we literally know that these guys know each other and coordinate as a cartel. And you can have, in one conference in 2015, 80% of Bitcoin mining power stood on a stage together. Decentralization is basically fake. All of this is for nothing. Other promises, uncensorable and irreversible. So these are actually true. Well, you can't censor before the fact. You can penalize someone after the fact, but not before. But this turns out not to be what users want. They tried using Bitcoin as actual electronic cash. It's really bad at the job. It's very brittle. One mistake, your Bitcoins are up in smoke. I mean, everyone's heard the news story about the guy who lost his hard disk with his Bitcoin keys on it in a rubbish dump in Wales, and he wants to dig up the rubbish dump. In actual payment systems, consumers like chargebacks. They like the possibility of fraud being reversed. Merchants really hate chargebacks. It really sucks if you're selling stuff and you get bogus chargebacks because the credit card company hates you and they'll charge you more and might kick you off entirely. But the thing they hate more than chargebacks is customers who don't use the system and don't buy stuff. So they tend to use credit cards and so on because that way more people will give them money. Consumers love chargebacks. The financial system as it exists is reversible up to quite a high level. So with Bitcoin, errors, frauds, and thefts are not easily reversible. If I hack your Bitcoins and I pick your pocket from the other side of the world, those are my Bitcoins now. Irreversibility is a fraudster's charter. Irreversibility means it's free, it's open season for crooks. And it's brittle. One mistake, you've lost your coins. And this happens all the time. It still happens in crypto when people are buying their NFTs of bad cartoons of apes. It's really hard to do, and one error and your money's gone up in literal smoke. Now, you can't just print Bitcoins. The Bitcoin system will probably always stick at 21 million Bitcoins maximum. There will never be any more. We've had 19 million issued already. But anyone can copy and paste the code. And they did. In 2011, as soon as you could exchange Bitcoins for money, when the Mt. Gox crypto exchange started, there was finally a reliable way to change money to Bitcoins, and people immediately made their own magical internet money. Take a few parameters, change them, you've got an altcoin. There are thousands of these things. So Bitcoin is just like gold if you could make new gold mines by cut and paste. What about the other coins? Do they solve any of the problems of Bitcoin? They don't really do a lot better. Now, Ethereum is the other popular crypto at the moment. Ethereum did one clever trick. It allowed smart contracts, that is, small computer programs. You can do anything with these. It's like, a good analogy is, if Bitcoin is like a spreadsheet of transactions, Ethereum is like a spreadsheet with macros. If you delve into finance and trading, you may find yourself writing some absolutely appalling Visual Basic in Excel. So with smart contracts, you can do all sorts of things. Like, you can even run a little program that generates its own set of crypto tokens, and you can call those a coin. So you have, I'll get onto the use cases when we get to the trading section. ICOs, initial coin offerings, DAOs, decentralized autonomous organizations, or DeFi, decentralized finance. They have little tokens attached. So Ethereum is proof of work like Bitcoin. It generates the CO2 of a somewhat smaller country. Now, proof of work is as dumb and bad as it looks. It is horrible and stupid, and it should never have been invented, but it was. So some coins decided, well, that sucks. Let's try proof of stake instead. This is a system where you don't generate a country's CO2. Instead, the idea is that whoever has the most coins, that shows the most commitment. They should get more coins. Now, that means the rich get richer, and it re-centralizes much more quickly. They still claim to be decentralized, but that's because decentralized is not an operational reality, it's a legal fiction. But who can we sue over this terrible Bitcoin network? There's nobody we could sue. There's nobody we could take to court over this. That's the idea. The whole idea is to say you're decentralized is to evade legal responsibility. That's what it actually means, because it's not an operational reality. That's important to keep in mind. You may be able to shield yourself, but similar to piercing the corporate veil, if you indulge in bad enough shenanigans, you can probably work out who's responsible for the system. Let's get on to cryptocurrency and finance, just being on topic. You can make a bundle in cryptocurrency. I would be lying if I said you couldn't. However, every dollar you make is on the back of someone else losing that dollar. Everyone in crypto works in dollars, by the way, not pounds. They work in dollars. So the thing about Bitcoin had a very complicated political ideology attached. Markets don't care. The market's ideology is number go up. So all the crypto assets are traded in the same markets, typically Bitcoin exchanges, which are a bit like banks, except they're rubbish. So Bitcoin, Ethereum, the assorted altcoins, the assorted tokens running on top of Ethereum or on top of some other blockchain, and centralized coins like Ripple's XRP, which is basically controlled by Ripple Labs, but it's traded on the same basis as all these others. They're all just objects you can trade and make money trading. Now, crypto markets are a hive of scum and villainy. There are no actual use cases for cryptocurrencies, like in the sense that a pound note is a piece of paper. It is actually a piece of paper. Crypto tokens literally don't have a physical use. They're just representations. So there isn't actually a crypto economy, right? This is important. You cannot buy or sell things with Bitcoins. There's a few people who will sell you stuff for Bitcoins. There isn't really much of an economy, none to speak of. Functionally, they're just trading commodities. You can buy them, sell them, hold them. If you buy one, your goal is to sell it to someone else for more than you paid. It's sort of hot potato. A pile of Bitcoins is not a pool of capital that you can invest in industry or whatever. It is literally just a pile of a commodity that you can't even use for something. All you can do is sell it. Trading is zero sum. This is dog eat dog. You have winners and you have losers, and you have a lot more losers. And it is very, very volatile. If you like volatility in your trading, cryptos are a great place. Literally, it can go up or down 5 or 10% on any day. It is ridiculously volatile. That's one of the other reasons it doesn't work as money. It's just a trading commodity these days. So what are the markets like? So we are very used to a regime where there is regulation in markets. I think people have forgotten what unregulated markets are like. Really, stories of hotshot stock operators from the 19th century, and they do amazing things screwing people over. You can't do that anymore because we have rules now. Why do we have rules? Well, basically because people want to get on with business. Normal markets are regulated with sensible rules. This is so you can get on with trading. It gives a lot more efficiency if the market has known parameters. Like, you can kill each other in the market, but the market itself, you can trust, like the London Stock Exchange. Nobody's threat model is that the LSE is going to take your money. And you can trust that the exchange is halfway competent at their job and stuff like that. I mean, as soon as we have money, we have the concept of other people's money and other people who want that other people's money. And people get very particular about how you handle their money. So financial regulation is really much more of a social expectation that is then implemented by the governments rather than a government imposition. You know, they want business to happen, but it has to happen within parameters so it doesn't go wrong. We know financial crises. Crypto markets, never heard that. You can't trust any of those things are true in crypto. The market is all but unregulated. The big trading is on exchanges like Binance, which is basically not in any jurisdiction. It's like a free-floating offshore casino. You cannot trust the exchange won't screw you over. There's been academic studies proving that Binance is absolutely front-running its own customers. There's exchanges in regulated jurisdictions like Coinbase and Gemini. They operate according to New York rules, some of the most stringent in the financial world. And that's great, but they have a lot less volume than the unregulated casinos. You can't even trust the exchanges are basically competent. You know, you cannot tell a proper exchange from a website run from someone's flat. If you have margin calls or tech problems or you're completely wiped out, too bad. Coinbase, the most popular consumer exchange, it goes up and down like a yo-yo. They're really unreliable. Like they routinely crash whenever the price goes up or down a huge amount. Here are things that are banned in regulated trading. They happen all the time in crypto. Wash trading, where you trade with yourself to pump a price. We've seen this on the Bitfinex and GDAX, the Coinbase professional exchange. Painting the tape, where you pump prices with which is like wash trading with 2 or 3 people. This actually caused the 2013 crypto bubble. Spoofing, where you place large orders to make it look like there's demand or supply at a particular price point, but you pull the order as soon as the price gets anywhere near it. This happens all the time. Front running your customers. The Yobit exchange, Binance, as I mentioned, the entirety of decentralized finance runs on front running people. Insiders trading on the exchange, literally trading directly against your own customers. Bitfinex did this. Crashing a market to burn the margin traders. That happens all the time. I'll get to that one because it's funny. This is the Bart pattern, named after Bart Simpson and his haircut from The Simpsons. This picture is actually an illustration from a lawsuit alleging manipulation on the BitMEX derivatives exchange. Now, a Bart is what happens. You'll see the price goes along, then it suddenly goes up a huge amount. Then it bimbles along for a while, then it suddenly goes down a huge amount. The up or down might be like a few minutes. That's not organic trading. That's someone manipulating the market. The way this works is you have a derivatives exchange like BitMEX, which trades long and short margin trading, basically bets on the price rather than actually trading the coins. They take their prices from the actual exchanges like Coinbase or Bitstamp. So you'll have someone dump $5 million of Bitcoins on Coinbase. That crashes the price because Bitcoin trading is quite thin. You can crash the price quite easily. That lets you burn the long margin traders and you win the margin bet. If the bet winnings are larger than the cost of dumping, you're going to get manipulation all the time. That holds even if Coinbase and BitMEX are completely honest, because the structure of the system is it encourages this sort of behavior. And this happens all the time in crypto. You will see these all over the place in crypto price charts. In other trading, you will see this a lot in thinly traded markets where the regulators are asleep. People who corner some rare commodity, for example, you'll see this a lot. It's very famous from Bitcoin, but yeah, this happens all the time. This is the mildest of the manipulations on the Bitcoin world. You'll get much worse ones. Now, here are some words you may have heard. I'll try to explain them. ICOs, initial coin offerings. This is when you do a token on, say, the Ethereum blockchain or some other blockchain, and it runs like an application running on top of Windows, you know, or on your phone or something. The blockchain is the operating system. This is the application. They're basically unregistered penny stocks. You do a bunch of tokens, say that they're for some collaborative effort, you sell them to speculators who hope the number will go up. Their heyday was 2017 to 2018. They were really obviously just penny stock fraud, and the SEC came down on them with a great big status to boot and said, actually, no, you can't do that. DAOs, decentralized autonomous organizations. The most famous of these was in 2016, one called The DAO, where they thought they'd have an independent, free-floating financial computer program that humans could not interfere with because humans are evil and computer programs are great. So anyone who's ever programmed a computer might have heard of bugs. Every program has bugs. So if you have a program that humans can't interfere with, that's called the sitting duck for attackers. And so the DAO in 2016 was drained within days. Fabulous disaster. So nowadays they do things and say they're decentralized autonomous organizations. Often they're just someone collecting a pile of Ether, the Ethereum cryptocurrency, for a collective enterprise. They pretend to be more than that, but it's just literally a business with a bit of computing to organize things. DeFi is called decentralized finance. This is a thing where you can set up automatic fancy trades between minor altcoins. This is on all in public, so people can see your trades and front run you. It gets the prices of things from other places that are called oracles, which may or may not be up to date, and sometimes you will rig the oracle. There are so many ways to manipulate this that the way DeFi actually works these days is experienced traders from hedge funds and so on get into crypto and they just skin the suckers, of which there are endless numbers. Lots of get-rich people, lots of actual experienced traders skinning them over and over. That's normal. Oh yeah, you can get front run by the actual miners on the Ethereum blockchain as well. DeFi actually invented whole new terms for scams like rug pull. When you put out a thing, everyone buys in and then you disappear with the money. So these usually have tokens associated with them, and the real market's speculation on the tokens. A lot of venture capitalists in Silicon Valley are getting into this stuff because they want to dump the tokens on retail, and that's how they make their money. So the regulators are paying attention. The SEC has been coming after DAOs and DeFis just lately. They've been after ICOs for ages. I would say my advice to you is treat this all as highly speculative. It's basically gambling. If you think you are that good that you're a professional gambler who can not lose your shirt, good luck. You'll need it. You may have heard of stable coins. Now, the idea of these is you have a crypto token. Instead of being hugely volatile, it is pegged to the dollar, usually. The idea is they have a pile of dollars in reserve, and they say one token is worth one of these dollars we have definitely in our real bank account that definitely exists. It turns out sometimes that they don't exist. The main crypto trading stablecoin is Tether. This is a very dodgy construct. They've been fined repeatedly by the authorities, by the state of New York. They were kicked out of New York entirely by the Commodities Futures Trading Commission. They claim to have 13 employees total, managing $80 billion in assets. Like, in normal finance, you expect thousands of people on that job. Tether actually confessed in one of their early white papers, they were bright enough to take out later, that their main purpose was to evade money laundering regulations. You don't have to tell the authorities what you're doing. It's much easier. You know, all that tedious messing around with not being able to get banking and so on. You can use tethers instead. There are other stablecoins such as USDC, which is slightly less dodgy than Tether, and also they're in clear US jurisdiction. But none of these people have ever been properly audited. They do snapshot attestations, which can be fiddled in a number of ways. There is a big push in US regulation to turn all of the stablecoins into regulated banks that have to behave. I think that's a good thing. I must mention NFTs. They're the hot thing at the moment. A bad picture of a monkey, which they sell you claiming that you bought the picture. An NFT is literally, I have to overstate how dumb this is. It's just a token with a web address in it. Like you just have, it just points to an address on the web of a JPEG. It is like having I hand you a piece of paper that says Mona Lisa, and I say, you have bought the Mona Lisa. You haven't bought the Mona Lisa. The marketing these things is hugely fake. The most famous one was the artist called Beeple, who sold a JPEG for $69 million. So it turned out the buyer of that was a guy who Beeple was in business with, promoting Beeple's artwork. So it wasn't technically completely a wash trade, but it was very like one. Basically, the market is fake. They're desperately hoping for suckers to get in with actual dollars. It's been heavily promoted by celebrity agencies who have a share in the NFT markets. There's no evidence of a real consumer market. NFT advocates will talk about things you can potentially do with NFTs, where potentially is a word meaning doesn't. The actual market we have is made of shenanigans. It's not clear that there's great business to be done in NFTs if you're not one of the insiders looking for suckers. Know your customer. So it turns out that crypto is used heavily for money laundering. A lot of regulations have been coming in just 2021, actually. That means that crypto trading must be made more traceable. This is a worldwide thing. Europe, UK, US. The UK tends to stay in harmony with the EU on this because we want people to still do business with us. I will tell you that know your customer is a nightmare for retail traders. If you think, well, look, crypto sounds cool. I think I'm pretty good. I can make money at this. You better talk to your bank first and have it absolutely clear, because in the UK especially, they shut your account if they think you're dodgy. So if you're an institution or a company, it's a bit better, talk to your bank first. So summarize. When trading cryptos, the trading is zero sum. It is extremely risky. There's unregulated. You have no recourse, and everyone is a crook out to skin you. You can make a fortune. You are more likely to lose a fortune unless you're as good as the sharks the pool is full of. So trade carefully. I'm going to finish up with blockchain in the enterprise. So this is a thing you may have heard of where people say blockchain has helped our business do wonderful things, which we can't quite specify. So what any organization wants, they want more efficient bureaucracy. They want to run more efficiently. Can we make this work better with a blockchain, perhaps, as our back-end database? So the history of this was Mt. Gox exchange collapsed in 2014 after a Bitcoin bubble had popped in 2013. So a bunch of people from the JP Morgan Bitcoin interest group thought they could market the tech to businesses as blockchain technology. And they also called it distributed ledger technology. That's always a euphemism for Bitcoin. You know, a shared Excel sheet would be a distributed ledger, but no, they mean Bitcoin. The promises are still the same promises that Bitcoin makes. Blockchain is fundamentally a collection of marketing promises. Here are the promises. Literally the Bitcoin promises, just change the buzzword from Bitcoin to blockchain. Really, you look at this, you'll see they've changed just the buzzword. It's decentralized, fast and free. Who is decentralized against is never said. There's no sensible threat model ever given. So the blockchain, as you've seen, it's a ledger you can't alter previous entries in. That's absolutely a GDPR nightmare. You don't want to put personal data into this thing in any form. Then they add smart contracts, little programs. I've seen actual diagrams advertising this stuff, which has a bunch of people on one side, a company systems on the other, and there's a big blob in the middle, and it says smart contracts, then the magic bit. If you see smart contracts, think we're the computer. Now, these are actual promises from one large vendor, IBM, when they were still pumping their blockchain unit, which they have since shut down. An enterprise class, cross-industry, open standard for distributed ledgers that can transform the way business transactions are conducted globally. And this one, highly secure blockchain services and frameworks that address regulatory compliance across financial services, government, and healthcare. So you'll note that those are is statements that are really could. Can is doing all the work there, because actually it doesn't. No software does all the stuff that they say. So the marketing promises things that literally don't exist yet. There's one called patient-controlled healthcare data, which is absolutely insane. It's like, imagine your granny has to keep her entire health record on her phone, and if she presses the wrong button, it's all gone. This is supposed to be a good idea. If it sounds too good to be true, it is. Like, one healthcare webinar I attended, it was run by a Big Four accounting firm. It was about how you could use blockchain in healthcare. The magical bits were all done by smart contracts. Someone asked what this could do for the NHS now, and the guy said, it's like predicting Facebook in 1993. They were fobbed off with gobbledygook. But, and this is the important point, they will take your money now. So usually in business, you don't want to use proof of work because it's stupid. You want to use a permission to blockchain, where you only let people on if they're allowed to be. So all participants are known and authorized, because you don't want your back office on the public internet. This is called a database. Even if it's shared, someone runs it, controls access. This is called a consortium. We know how to do consortia. You don't need software for this. It doesn't give you anything. Smart contracts are computer programs. You must deploy a perfect program, or else you're going to get exploited. You don't want that. Ethereum was written to run smart contracts. So Dr. Gavin Wood is a computer scientist. He wrote the protocol document. His startup lost $160 million of Ether in November 2017 to one programming error. It's gone. They can't get it back. They've lost the keys. It's irretrievable. Even the smartest guy in Ethereum cannot make that work. So a salesman will tell you the magic but's done with smart contract and means we could do it on a computer. It'll be like any new large IT system. In the real world, almost no blockchains are in production use. The World Food Programme is a great thing. They have a single-use private Ethereum that is a database, but they keep talking up Ethereum as the way that they save a lot of money distributing money to people. It's all done because they took in the funding themselves in-house, not because they use different software. They still talk this up as an Ethereum use case. There's a book on blockchain which talks about this is their entire first chapter, how great this is. Press releases. A straight majority of press releases about how great blockchain would be in enterprise were from IBM. The Walmart and Maersk supply chain systems were actually deployed in the wild, and they were all centralized systems run by IBM with all the machines on the IBM cloud. Questions to ask to a blockchain salesman. Are they mixing up might, could, and is? Can the system do all the stuff they said? How will the system scale to your data? How to deal with human error? If this is to deal with trust issues, what is your threat model? do you trust them less than the people you work with now? If you don't, if you trust them as much as you trust the people now, why are you using a blockchain? And the fundamental question is, what does this get you that a centralized database or other existing technology does not? Now, the GDPR. You're in Europe, so therefore in Europe and the UK, the GDPR is still law, and any personal data must be redactable. You must be able to edit the database. You cannot use an immutable data store. There are blockchain for marketing pitches that claim using a blockchain will help GDPR compliance. That's a lie. So the good bit is the 40-year-old data structure. Look, you can actually verify that something is tamper evident. It's append only. It's really good. So a real life example is KSI blockchain from Estonia. This is widely touted as a vast success for blockchain. You see it in blockchain case studies all the time. It's literally just the append-only ledger. Then they confessed they only use the name blockchain for marketing, and it totally worked. And they've said, if blockchain goes out of fashion, we'll change the name, which is wonderfully direct of them. Or Git, a computer program for storing computer program code. Anyone who's programmed will know this one. Like, this looks very like business blockchain. Every ledger entry is a program code change, full history. You can have branches of code, maintain and merge them. Nobody calls it a blockchain. Also, it was invented like 4 years before Bitcoin. It works in a comparable way. So here's the conclusion. Magic doesn't happen. There are no get-rich-quick schemes. Never put personal data in a blockchain. Could means doesn't. Potentially means doesn't. Incentivizes means doesn't. Anything can potentially be fabulous in the hypothetical future. Never accept that as an excuse for current suckiness. If it sounds too good to be true, it probably is. So this is me, David Gerard. You can find me here, and we'll make this PDF available afterwards. So I shall just go off share, and you should be able to see me now. Hello.
Hi. Strangely enough, we could see you while you were presenting, but we can't see you now.
What?
You're coming back, I think. Yeah, there you are. Yeah, thanks very much for that, David. That was very interesting. Well, I have some questions, and if you have questions, the easiest way is to just type them in the chat. So if you type your questions in the chat, I will read them out to David, and that'll make it easier to follow on the recording.
Yep, you read the questions out when they come through.
Okay, great.
Ask any questions you like, the most basic possible questions. I love getting the questions because they tell me what people are actually concerned about.
So while we're waiting for them to come through, I'll ask a question. The other module I teach is financial bubbles and crises, and one of the subjects that comes up a lot is predicting when something is going to collapse, which is always the hard part. You can tell something is unsustainable, but you just don't know when it's going to fall apart. I've seen you mention that you have a feeling that this crypto ecosystem is starting to run out of dollars. What gives you that idea? What are the warning signs you look for when it might crash?
Well, as you know, if we could predict crashes, I'd be much richer than I am. I'd be writing books for fun, I can tell you. But there are things like the current crypto bubble. We've spent 2021 in a cryptocurrency bubble. I think that the initial bubble was started by a tether pump. Someone pumped a lot of tethers into the system, manipulated the price upwards. They got a lot of headlines in the papers because there is no more interesting story in the financial press than number go up. That is absolutely the one thing people want news about. They don't interrogate why enough, I think. So I'm pretty sure that the bubble was started artificially because this was the telling point. There wasn't any increase in retail crypto volumes on the actual dollar exchanges. Normal people weren't getting into it. We did hit the retail phrase when it was actually a standard economic asset bubble, when retail suckers are diving in, naively thinking that they will always be able to sell this on because they've never had a bubble before. I think that started in February when Elon Musk of Tesla said Tesla Cars is buying a bunch of Bitcoins. Then the price shot up. This is when I had people telling me that they heard people down the pub talking about their Ethereum portfolio and other horrifying stories. So Musk sold Tesla's Bitcoins in May, and this helped his quarter one numbers quite well. So big job done, you know. He's quite successful at the business thing. So that I think the retail suckers mostly went home by about June. And what we're seeing now is a lot of attempting to pump the price up, but I think the retail dollars have gone home for the most part. Volumes are down. So one thing that's really telling is crypto miners in the US, they were kicked out of China in mid-2021. China had the world's cheapest commercial electricity, but they decided actually, yeah, Bitcoin miners suck because we're trying to keep our CO2 numbers down. So a lot of them moved to the US and Canada. They moved to a lot of poor countries like Kazakhstan and so on, where power was cheap, but they didn't have good infrastructure and they didn't have a very robust sort of legal system or stable governments. So the US and Canada do have a good legal system and stable governments, very stable by comparison, and relatively cheap power. So they moved to the US. So a lot of the miners, they aren't selling all of their mined Bitcoins. That's new behavior. Usually miners have to sell their Bitcoins for actual dollars because they can't pay their power bills with Bitcoins. They have to pay them with dollars. And what they've been doing is they've been stockpiling Bitcoins. That doesn't make sense unless they're betting on the price of Bitcoin going up, which they might be, but this is new behavior, as I said. I've only seen that behavior previously when a miner has mined a lot of some coin that wasn't very popular and they ended up with an inventory of millions of coins that they're stuck with. It's basically just a lump of garbage on their books forever. And they can mark it to market, but actually the actual price is zero because the market doesn't exist. So I think that they aren't selling their Bitcoins because they're afraid of crashing the price. They've been paying their bills by borrowing money from various cryptocurrency companies to pay their bills. They've been trying to get into using Bitcoins as loans, as collateral for loans to borrow from banks. There's one company, MicroStrategy, a software company that got into Bitcoin last year. They did an investor presentation in December where they said that was literally their plan. Use the Bitcoins as collateral for loans from banks. Now, the point there is to try to turn the bank into the sucker of last resort, you know, the bank holder of last resort, where the Bitcoins will be, even if the loan goes bad, you can't cash in the Bitcoins because the market doesn't exist. The price will crash. So retail dollars are the most precious commodity in crypto, and I think they've been a bit lacking lately. So the price has got to collapse sometime, but I can't time it.
Okay, great. So we have some questions in now. So first of all, Tomas, he asks about what do you think about fiat lending in the crypto market that is used to fund leveraged trade of users, provide high annual rates such as 10-15% a year, and financial professionals outside of crypto see it as an alternative fixed income strategy. Is it legit?
So a lot of these operate very like Ponzi schemes. When you see outrageous interest rates, your first thought should be, what's wrong with this? Because, you know, there's no get-rich-quick scheme, and there isn't a get-rich-quick scheme in finance either. A lot of these companies, BlockFi, for example, has been called out for this quite a lot. They got busted by a whole bunch of US state regulators and most recently by the SEC. They've had to pay a $100 million fine. Because if you loan out something and pay interest and you're not actually a bank then it's a security under US law. It's an investment contract. And you have to be regulated and register with the SEC and do all the basic stuff. Like the SEC is not harshing your mellow. They love business. They love you to go out and make a great big pile of money, but you have to follow the rules, So I would be highly suspicious of these offerings. And can you actually cash out? A lot of BlockFi customers are reporting inexplicable problems actually getting their money or even their Bitcoins out. So you can make money. The source of it is DeFi traders who are stupid. There's a limited number of suckers. This is not free money. So I would be exceedingly cautious and check you can actually cash out. There are ones like Celsius, where it turns out a whole pile of their C-level staff keep getting arrested for money laundering. These are very dodgy players, and in crypto, you can go back in after dodginess and get forgiven and just keep on going. So the answer is, this is extremely risky professional gambling where you can only trust the bookmaker to a certain extent. I guess is the answer.
Okay. Yeah, I think it's it must be like an illiquidity premium, because he's asking like you can lend money to people to trade in crypto, and because it's margin lending, you can make a call on that very quickly, and it can be very, very lucrative for banks. But because the whole thing can fall apart instantly, run out of retail dollars, that's where the high interest rate on that probably comes from.
Yeah, it's risk. It is massive, massive risk. And a lot of the point is putting risk onto people who don't think the risk is there when it is.
Yeah.
And a lot of these companies are pretending to be banks. They're sort of doing shadow banking of an incredibly shonky made up as they go a long way. Mm-hmm. I mean, there's all sorts of shenanigans you can do in DeFi. There's the old one where you dump pure dead altcoin by putting up as collateral for a loan of Ether. Then you default on the loan. Oh, no, you've lost your 150% collateral that you couldn't sell anyway, and now you've got liquid Ether. Yeah. There's a whole lot of these things you can do.
Very good, yeah. So Rory asks, what will they do with all of the Bitcoin mining farms when it's all mined?
So the plan is the miners will just process transactions and get transaction fees. How sustainable that is anyone's guess. A lot of people suspect that, look, the essential point is to keep the music playing so the music doesn't stop and people don't have to fight for the limited number of chairs and try to cash out. You must keep the game going. I think crypto is a very small number of large players who all know each other. This is not a highly competitive market. It operates much more like a cartel. You're going into a somewhat rigged casino. Be careful. These guys, they've been the same players for the last decade. So the miners are in there as well. The way they're doing it is that I think that if they need to, they will change the operating parameters of Bitcoin. If that's what it takes to keep the music playing, they will change the parameters. They will override the objections of the purists, and they'll do whatever it takes to keep number up. I think that's, as far as I can predict what will happen, I think that's what will happen. Unless something drastic happens, I can't actually see Bitcoin being banned or whatever. I predicted long ago the future is more and more regulation. And we're seeing that already, as I said. More and more traceability. You'll end up with like a two-part system. One part will be actual money for Bitcoins, which will be highly monitored and tracked and traced. And then you'll have people outside that, and they'll have a hell of a time getting their coins into the system. I think that's what the future is. We're seeing it happen already. Okay,
great. Patrick asks, which stablecoin do you think is the most reliable, if any?
Well, that's a good question. None of them really. I mean, the least worst is probably Pax Dollar, because they put their coins in a known bank, Silvergate Bank, who are basically the bankers for the crypto industry. How do they make their money? No one can quite work this out. If you can't see how someone's making their money, they're going to be making it in a way you don't like. Because Silvergate loves the crypto industry because they don't pay interest, which is a marvelous thing in a customer. So I don't know if they pay Paxos money on the backing for Pax dollars. Pax dollar is also the Binance dollar. Binance is a very dodgy exchange I would not go near within a mile of, but it's where you make a lot of money if you're feeling lucky. The Binance USD is actually a Paxos USD rebranded. It's sort of a white label deal. So Paxos is the one that's definitely got the most backing, but even they've never done an audit, by the way. They've only ever done snapshot attestations. A full audit traces not only how much you've got, but what its provenance is. And that turns out to be important because Tether turned out to be dodgy in all sorts of ways. Like Tether's backing was, they kept track of it on a shared spreadsheet. That was where they accounted the reserve. And sometimes they remember to update the spreadsheet. I'm not exaggerating. I really urge you to read the CFTC settlement and the New York settlement. I linked them in the PDF. They're amazing. The stuff they did, they were so bad at this, and they're making billions, and the world is wrong.
Yeah.
So anyway.
All right, so Robert then asks, could the concept of cryptocurrencies be more desirable in countries with very authoritarian governments or very high levels of corruption and poor regulation in retail banking?
So this is a hypothetical. So anything could happen. It's whether it does happen. I mean, there is a small use case there. I must stress there is a use case for cryptocurrencies, which is moving money past regulation that should not be there. Now, what regulation should be there? That's a matter of opinion. There is a use case shifting your money out of a country. That is a use case. Whether it's a good one would be a facts and circumstances matter. As a general solution, no, I don't think it could work. Money is a social construct. So there are some countries that have dollarized. They just went, bugger it, we're going to use US dollars as our currency. They basically gone to a hard money economy where the hard money is a foreign currency. The government can't create or destroy the money. They can destroy it. They can't create it. They cannot print money. They cannot do monetary policy. All bills have to come due. That's a really harsh, bad circumstance for an economy, but it's better than what they had before, which was hyperinflation and so forth. So there's no job that crypto does that dollars don't do better in that condition. From the US perspective, the US dollar is a fiat currency manipulated at government whim, because that's the job of the Federal Reserve, to manipulate the currency for economic policy. As far as those countries are concerned, it's the huge economy next door that's 1,000 times our size. I guess we can trust their money. So, I've been looking at El Salvador a lot lately because they adopted Bitcoin as a currency and it's been an absolute car crash disaster. So our worked example is very bad. But they use the actual people on the ground, they still trust actual physical dollar notes much more than they trust the Bitcoins.
Okay, great. So Harry has a good question. He wants to know, what do you think of Vitalik Buterin and Charles Hoskinson? Do you believe they are snake oil salesmen or are ignorant of the size the project can grow? Are they scam artists or ignorant?
So I certainly wouldn't call someone a scam artist on camera in the UK without being able to back myself up a great deal. However, no, I don't think I think they're both sincere about their projects and they think their projects are fantastic. Vitalik is by all accounts, a very nice fellow. He is desperately sincere. Everything he says he means. He's a good chap. I argue with a lot of his decisions. I think he's dead wrong about a lot of stuff, but he's not a scam artist. I wonder about some other people in the Ethereum ecosystem, but Vitalik's pretty okay, actually. Basically, the Ethereum developers are very sincere blokes. They're trying very hard to do what they do. Ethereum is trying to move off proof of work. but they've been saying this since 2014. Basically, they're trying to invent new computer science, fundamentally. And I think their system will centralize anyway. But they're sincere about the effort. Hoskinson, none of the promises for Cardano have worked out on time in any way. It was literally a centralized coin for 2 years. You know, they had a central coordinator node. It was a database. They tried adding smart contracts and they couldn't get them to work right. And they're not Ethereum compatible, so no one wants to port their contracts to them and stuff like that. Most other copycat blockchains just use the Ethereum virtual machine to run smart contracts. So you can take your DeFi rug pull and port it to Solana or Binance or AVAX or whatever, and run it just the same and disappear with all the money 5 times instead of once. But functionally, Cardano, the coin ADA, it's a minor altcoin for traders. The vast majority of trading is against tethers. It's just another minor altcoin. I would say that Cardano fans are very avid and will reach out to you on the slightest provocation or none. But I would say that they have a long-running deficit between promises and realities. It is actually a crypto. You can trade it. They're trying to make smart contracts work fine. I don't see that they're doing anything new or radical, and they have a real lag between promises and realization.
Okay, thanks. So Rory asks, despite the issues with cryptocurrency that you've described, why do you think the likes of PayPal continue to facilitate it?
Oh, that's easy. It's because the CEOs are Bitcoin holders. Tesla, PayPal, every time a big company decides we're getting into crypto, it always turns out that someone at the C level is a massive holder. So fundamentally what they're doing is they're using the company credit card to buy a press release for Bitcoin. If you look at what PayPal is actually offering, it is not cryptocurrency as any crypto advocate or fan would actually accept it. It's a walled garden. You can only buy and sell cryptos inside the system. You cannot move coins out. You cannot take coins in. I mean, fundamentally, it works like a bucket shop, just betting on the price, except they're actually buying coins, so they're not technically a bucket shop. But yeah, it's not part of the crypto system. Like PayPal say, you can buy things with the Bitcoin balance, which you needed to have bought with dollars, you know. It's a way of trading. I think Revolut offers the same thing, where you can trade inside the system, but it's hard to get coins in or out. This is because they're super, super worried about know your customer, anti-money laundering stuff. PayPal is so paranoid about anti-money laundering. It's a pain in the backside for actual consumers. And there's no way they were going to risk any of that with cryptos. So they have implemented Bitcoin in the least Bitcoin-like manner they possibly can.
Okay, great. So Ryan asks, given all the flaws in the crypto and blockchain system, do you see in the reasonably near future cryptocurrencies that can be improved into general use, or is this impossible?
So at this point, we hit the distinction between can and are allowed to. That's the big thing that took down Facebook's attempt at Libra cryptocurrency. Now, I've written a whole book on this, but that was started by 4 Bitcoin advocates inside Facebook. And these were very sincere people, by the way. I have questions about Mark Zuckerberg's sincerity based on the historical evidence, but these guys were all very sincere Bitcoin fans. They wanted to do Bitcoin, but Bitcoin sort of sucked in various ways. So they came up with ways that they could make something that worked as a currency. So the trouble is that they wanted to make this a retail currency that would be part of the real economy where you and I live and do things and eat and work and pay rent and stuff. So that caught regulators' attention. Literally within minutes and hours, they were saying to Facebook, no, you absolutely cannot do this. Because money is a social construct and regulation exists for reasons. And also because Facebook's plan had elements that were literally what had caused the 2008 financial crisis 11 years previously. They had a professor of economics in the plan, and he had apparently forgotten recent history. So if you want to give a regulator post-traumatic stress disorder, tell them you're going to do 2008 again. It was amazingly dumb. So if you want to do a general cryptocurrency retail, that's going to be a thing of massive interest to the existing system, and you probably won't be allowed to. If you try to sneak it in, or if you say, buggy is all, I'm a sovereign country, I'm going to adapt Bitcoin as my currency, which is what El Salvador did, you're going to risk getting yourself cut off from a financial system. And that's very risky for El Salvador in particular, because their economy is US dollars, and about a quarter of their GDP is remittances from Salvadorans living in the US sending money home. That's a huge part of their income. They're poor, it's a poor country, but they're quite very smart and talented people. A lot of very skilled people there. They go to the US, they make a bundle, and they send money home. He's risking that by setting up a weird Bitcoin regime, and he's been told repeatedly, you're risking your connection to international world. There are people who see the disaster outcome as being Venezuela, where they're cut off completely, that sort of thing. So the answer to your question, could it work if it was better designed, is, will it be allowed to work? Can government suppress it? Well, that's a good question. That was one of the fears with Facebook's Libra, where instead of dollarization, you'd have Libraization, where Libra would functionally take over the functions of a currency in that country. Private currencies don't have a good track record. There's a reason why money is a public good that's regulated, and central banks are public institutions. There's a lot to complain about central banks, but they are in fact public institutions. They comport themselves like public institutions, and they do understand that if people are setting fire to things, they're probably not doing their job that time. So I would say that I think it's unlikely.
Okay, great. So Hanjin asks, what do you think of metaverse crypto coins?
I mean, it's all like Second Life, but worse on the blockchain. People seem to have forgotten the hype around Second Life, which is a virtual world system. Came around 2007-ish, 2008-ish. Had all these companies saying, yes, we're moving into Second Life. We're setting up a university in Second Life. IBM goes into Second Life, but they have avatars instead of being some sort of weird sort of tiger creature. They'd be an avatar of a guy in a suit. So that hype petered out because there was nothing to it, and it was nonsense and gibberish. So what we have now is Second Life still exists. It's a fun game you play because it's fun to mess around in a virtual world. The blockchain versions have some sort of things, but basically the point is to sell you tokens and to trade tokens and speculation. The game is just an excuse. It's the technological hand wave on the get-rich-quick scheme. So the answer is, I don't think there's a lot to it. Maybe you can make money out of it if you're quick. I think the main way to make the money is to issue the coins. If you've heard of it, you're too late, that sort of thing. It's a very shonky, fast-moving, dodgy environment full of unreliable people. You can make money in it, but it's trade carefully.
Okay, good. So Michael asks, although you say there's no sensible threat model, access to banking is currently being restricted in Canada. What are your views on Bitcoin providing an alternative to the government, where governments have, say, discriminatory policies, such as, well, if this type of thing could have been used to tackle civil rights protests in the 70s or the civil rights movement in America. I think he's spotted a challenge to some of the points I made in the lecture last week, because one of the arguments I made then was that this idea of being tamper-proof was a very theoretical benefit, because it's not really the case that banks will just delete your money, or the government will come in and delete your money. And then the day after I said that, Canada froze lots of bank accounts without any due process. So it's a good question. What do you think?
Sure. As I said, that is a payment use case of Bitcoin, working around unfair government restrictions. Obviously, governments don't like that. And really, the biggest use case we've seen of that in practice is funding neo-Nazis, which is not the most attractive use case in a lot of ways. It's a bit mediapathic, but it is a thing you can do. It's very easy to trace neo-Nazis online because they cannot help but advertise themselves, sending 0.1488 Bitcoins, that sort of thing. With the Canadian truckers, a lot of the Bitcoin thing was, they're not even truckers. A lot of them aren't even truckers. They're protesters who happen to have a truck. Actual Canadian truckers tend to be quite well-behaved people who like vaccines a whole lot. So a lot of these people can't work Bitcoin, it turns out. It's so hard to use that it doesn't do the job. And a lot of it's being promoted by one guy in the protest who loves his Bitcoins and wants to pump Bitcoin. So most use cases tend to come from some Bitcoin promoter hypothetically thinking maybe we could use it for this. Could a cryptocurrency that works better be used for this? Well, ultimately, then you're going to alternate possible stores of value that are movable. And the answer is sure. Though at some point, you're going to have to touch the system of real money where you can buy things, because you can't buy things with your random crypto of the day, but you can buy things with actual money. And at that point, the government, in its role as the elected representative society, absolutely has a role to say about whether you can use the stuff. People will say, but it's my money. And that's absolutely a fair point. And the government knows that, and they have to be careful about this. So it's possible that Canada will now go nuts and start locking down protesters' bank accounts and really making trouble for them. Maybe we'll see a role for Bitcoin. Who knows? I don't think it'll be for Bitcoin because Bitcoin sucks, but maybe for some other currency, who knows? But I think it'll be a limited role because at some point you have to touch the real money system if you want to spend money.
Okay, great. So Michael also asks, do you believe that the current system can continue to work, where we require low interest rates and inflation to stimulate economies, or should we embrace the deflationary nature of technologies?
So deflation is bad, and you don't want deflation. And anyone who says you want deflation is an idiot. That's the first thing. Deflation is how to make your economy completely seize up. It's very stupid, and anyone who advocates this needs to go and read a book. So that's the first error of cryptocurrencies, because none of these people will ever, ever do the reading if it wasn't written by another Bitcoiner. That's a key thing. They try very hard to sound like they know what they're talking about, but they do not do the reading at any point. They don't understand how anything works because they started from gold standard economics, which we abandoned because it wasn't working anymore. There's a lot to complain about in the current system, but Bitcoin economics would, I think, actually make it all worse. So if someone says this is bad, we have a solution, that doesn't mean the solution is a good idea or should be taken seriously. I would say do the reading. And so too much inflation is bad. Low inflation, you want a certain rate of low inflation, but not too much. And you don't want deflation, because deflation, your money is worth more today, worth more tomorrow than it is today, so you don't spend it today, so the economy seizes up. And we've seen this repeatedly through history. Deflation is bad. I think that's the answer to that one.
Yeah, my lecture on the Great Depression is on Thursday, so for those of you on Bubbles and Crises, this is all about what happens when you get deflation in an economy, and it's for some reason much less well known than the problems with inflation, even though the deflationary problems tend to be much worse.
Yeah, I mean, we went off the gold standard basically because of the Great Depression. Countries left the Great Depression as they went off the rigid gold standard and went, bugger it, we're going to print dollars. Turned out that was a good idea. It gave us quite a few decades of an excellent economy that actually worked.
Yeah. So Arlene asks, is there anything blockchain is useful for, or is it a solution created for a problem that doesn't exist?
Yeah, basically. The blockchain as we know it is not new technology, as I said. There's like 30 years of stuff that came before Bitcoin. I mean, there are systems that were fundamentally a shared ledger, a shared Merkle tree ledger with proof of work to decide who could add a new entry to the ledger. But they weren't current, they didn't say they were money, and they didn't have a political cult attached to them. I think attaching a political cult to Bitcoin was the key to Bitcoin's success. That is, when people are very determinedly wrong about something and hold on to it as hard as they can, they'll promote it twice as hard, and that's how Bitcoin got pumped along. So the blockchain data structure, it's just a data structure, you know. Actually, my day job is in IT as a system administrator. I've literally never seen a case where blockchain type data structure would be the correct model for a system that would do the job any better than an existing system. I fully expect that people will shove blockchains into systems that are more useful than not having the system. And then we'll be stuck with that dumb element in the middle, but the system as a whole works, so we should keep it. The World Food Programme example is one of those, actually. It's a good program. It does good things for the world, and it's got this stupid bit in the middle, but that doesn't matter because it works, so leave it alone, is my professional opinion as an IT person.
Okay, great. So Tian Chen asks, in theory, is there any chance that an algorithmic stablecoin, which is not backed by the USD or any real assets, could be invented and applied in the real world economic activities and possibly be a threat to the monetary system?
So firstly, algorithmic stablecoins have been tried over and over, where you have a coin which has a backing and it uses automatic buying and selling and marketing to keep the coin stable no matter what the backing does. Typically, this lasts about a week. Then something happens with the backing and the stablecoin parameters fail and it goes up or down stupidly. Like, ultimately, you're betting that none of the numbers can go wrong all at once, and that's a really bad bet historically. You know, you can hedge against all this stuff happening, but sometimes times just go bad. This especially happens in crypto, which is stupidly volatile. Algorithmic stablecoins fail all the time, so they can't do that job stably because they just actually don't. You know, observably, they don't. If someone claims they have one that will, I'd say show us. You know, ultimately, or ones that work without someone pumping the numbers or fiddling the numbers somehow. As for whether they can be a hazard to the existing monetary system, yeah, sure, if they go unstable, which is what generally happens with algorithmic stablecoins. Like, the market does what the market wants to, and it will do something that will screw you up a certain percentage of the time. And you cannot abstract it away to an algorithm. Ultimately, that's a human abrogating responsibility. You can't do that. You know, it's finance. You're responsible. there is someone whose fault it is.
Okay, good. So Tian also asks, is there a chance that crypto communities could build their own macro financing system? He gives some details of how this could work, and then asks, could it constitute an alternative to any sovereign or existing financing systems?
So Bitcoin's promise was we will eliminate the middleman. What they actually did was they built an entire elaborate system of middlemen, the same as the previous middlemen, except not competent. We have a lot of that stuff. You know, we've got exchanges, we've got banks, except bad. We've got lenders, except shonky. We've got scammers of all sorts, reiterating the entire history of financial fraud. We have a huge system. What we don't have is people being able to buy stuff with real money for it. You have to go to actual money for that. Somehow it's failed to have an economy. So fundamentally, from the trading perspective, all of crypto is just a dollar derivative. You're doing this because you want dollars. There isn't really a way around that. As I said, it's a zero-sum system in total. No dollar comes out of crypto that some loser didn't put in. Every winner's dollar is a loser's dollar that went through the system to you. So you can certainly do elaborate things within that system. This is why this thing about crypto, people trying to borrow money from actual banks, is really interesting, because that's an attempt to weasel their way into the real financial system. I think the end goal there is to be on the bailout list when it all goes wrong. I think they're very hopeful on this. And the US government, for instance, the Treasury in particular, has noticed and is not having a bar of this. They're putting in a whole bunch of regulations right now about this, particularly about stable coins, but also about cryptos in general. And that's not a new Biden administration thing. The Trump administration did the same thing. Steve Mnuchin was the Secretary of Treasury under Trump. He was massively, he hated crypto so much. You know, he's a rich guy. He made a fortune himself, and he managed the nation's finances, knowing what money is and how it works and how to make it. He hated crypto so much. And like, his prescriptions are actually harsher than the ones that Yellen is putting into place now. So the first answer to your question is, well, not while it isn't part of the dollar system. If it does become it, they're basically doing that to get bailouts, and the government isn't going to put up with that. So they've built the elaborate system, but it's not getting them what they want, which is to be taken seriously as part of the dollar system. They're trying really hard.
Okay, interesting. So Tomas asks, if this is so easy and anonymous and people are naive, why can't I just bootstrap a crypto scam with 5 or 10K and pull a rug pull for hundreds of thousands or millions? He's not advocating this. He's not saying it's something that you should do, but what are governments doing to stop it?
Well, you could, but I'm definitely not advocating it. A lot of people do, because it's basically when you get lots of naive people who think that this is the future of money. Things are different now. It's a whole new paradigm. Then you get scammers to prey upon them. We saw that early on in Bitcoin. A lot of the scammers actually had past history as scammers, like mail fraud or Ponzi schemes or whatever. And then they just took these into crypto. And the other thing in crypto is you get a lot of people who are the sucker who thinks they're the scammer. Now, there's no sucker like the sucker who thinks that he's the hotshot operator scammer. I'm in this crypto pumping ring and I'll definitely make all the money. No, you're the sucker. I'll definitely start a great new system in DeFi on the Binance Smart Chain. It'll be massive and I'll just take all the money. Oh, look, all your money's gone and you couldn't actually get it set up. Whoops, you were the sucker. That sort of thing. So if you want to dive into the pool full of sharks and say, I'm going to be a shark, make sure you're not the sort of meat for the other sharks. I'd adopt due caution before you go into a den of thieves saying, I'm going to make a lot of money as a thief. It would be the sensible thing to do. Unregulated, trade carefully. Trade carefully is a word I say when I mean you're a fool if you do this, but I can't stop you.
Okay, great. Yeah, thanks for that. Before you go, I have just one more question myself. If you were to recommend, you've given us a very skeptical view here. Are there any writers or journalists or anyone who presents a relatively pro-crypto view who you would respect, who you would say makes good arguments or interesting points that you think give another side to this that you at least need to work quite hard to debunk? Or yeah, is there anyone you would recommend
for a pro-crypto view? No, because I haven't heard the arguments that are good. And when I see journalists get into crypto and decide actually it's good now, they tend to go through a process of saying, well, conflict of interest, that isn't bad, is it? Maybe we can have just a little bit of conflict of interest as a treat. Maybe I can just pump this crypto out of a massive bag of, and that's okay. Or they make arguments that turn out not to be good, or they turn out to have signed on as an ICO advisor or something. There's a lot of temptation there, obviously. And there is no crypto publication that forbids its journalists from writing about things they hold. Compare Financial Times or Bloomberg, where your holding must be zero.
Not even Protos?
Protos are pretty good. They're nice. I mean, I like their stuff. I read CoinDesk every day, and CoinDesk is massively pro-crypto. You can get useful information. I won't name them because I don't want them disappointing me, and also I don't want to paint a target on them. There are many CoinDesk writers I read who I read every day, and if they have bylines on it, I know it'll be good, It's absolutely a lot of crypto pumping garbage in the crypto media. It is not specialist trade press. It is marketing material, but you can get information out of it.
Yeah, my example of...
Which doesn't quite answer your question, but I'm not sure there is actually an answer.
It's a fair answer. There's no law of the universe that there has to be two sides to every story. It's a completely fair answer. But my example of someone who would give a fairly crypto sympathetic view was always JP Koning, but at this point he just seems very skeptical.
Actually, his blog is essential reading, but mostly he's a sort of subtle gold bug, I bet. On the other hand, he knows monetary policy exists and why it exists. Yeah, read JP Koning's blog, Moneyness. He's good. I read all his stuff. I don't agree with him on everything, but he's also been the guy who keeps naming things in crypto.
Oh, really?
He came up with the phrase distributed ledger. He came up with the first central bank digital currency idea, that sort of thing.
Okay. I think when I read him now, he just seems pretty skeptical, sort of extremely diplomatic, but
he knows his stuff, basically. Yeah, he's good. I mean, there's a lot of people I read, if you go to my website, I've got my news section. There's a lot of blogs and people I quote, I'm happy to quote the crypto press and the pro-crypto guys if they're saying something that's worth hearing. I mean, I know these people. A lot of them are fine. I mean, I know some crypto guys, they're friends, they're good. I think they're wrong about stuff. Usually they're realistic about present day reality, but they're more optimistic about the future. And fine,
Okay, great. Thanks so much for coming. It was really fascinating.
Thank you very much. I love doing these. And if you are a student and you are poor and you want to read my books, they're on LibGen. And if you're a student, you don't know what LibGen is, well, you need to learn.
Yeah. So I have to go and sprint to the other side of the campus and meet our guest lecturer for this afternoon. Thanks again for coming. I hope the students got a lot from it. We definitely got some very interesting questions there. And
thank you so much. I love the questions. They were excellent, well thought out questions.
Yeah. So I'll stop recording now and end the meeting. So
thank you.
Thanks again, and I'll hopefully be in touch at some point in the future.